If you're someone who trades only a few instruments, nearly there. Fuck off. Let's get into this lesson. Let's get into this whiteboard lesson. You make money when retail doesn't. Retail Ronnies, all of you, if you're called Ronnie, nothing against you, but the name fits well. Right, your mentor's washed. Right, just need to get that out. So, back with another whiteboard.
So Mark, what were you filming today?
You make money when retail doesn't. You've heard it before, retail traders constantly on the wrong side of the market. You hear all of it, but what does it mean? This episode, what I'm gonna do, I'm gonna show you a little bit of whiteboard stuff, then I'm gonna move over to the charts and share a few things. That's probably where you're getting caught out quite a lot. You need to have this in place so you understand how to not get caught on the wrong side of the market. Now, I've done a few little things on the channel before about that, but I don't think I've ever explained it in this way that I think could be really valuable. So it doesn't matter how you trade, it really doesn't matter. This is going to be of value to you. Actually, how you trade does matter. So if you're someone who trades one or two instruments, especially if it's USD based, this will help you out probably way more than you thought it would. So imagine you've got this range, right? This is the higher time frame. Let's say this is the daily, right? So you've got the daily swing, a larger range. You need to think about fundamentally who is driving the market, the big funds, institutions, etc. You know the spiel. But it's really important from a positioning point of view to know what that looks like. So as simple as this is our strategy. I want to be able to identify who moves the market and what it looks like. That's it. And I want to ride the wave of those ranges or trends. And that is in a nutshell how simple it is. So I don't want to overcomplicate that part. So what happens in between? You have to look at where is your edge. So where do you get a competitive advantage? Well, you know you can't move the market. Let's say you get moves like this. You can't affect, especially let's call this a large candle, you can't affect that. Retail can't affect that market. So you know this amount of volume to be moved can only happen from an institution and a fund. So by doing so, I want to identify, well, what does it actually look like where it's not a fake out? What does it actually look like where it's not a trap? The market is consistently leaving clues with structure, with gaps in price, candles, all kinds of clues. And it really doesn't matter how you're trading, these clues have been presented for a period of time. I actually done a video on the channel not that long ago, which was why market structure is king or something like that, because you can't argue with structure. So essentially, what I want you to think about is who moves the market, how can I identify what it looks like, and then how could I ride the wave? So call this the A to B leg. That's all I'm interested in. But then I use positioning to help me out. So let's say, for example, you're someone who trades a lot of USD based pairs. So let's say it is, let's say you trade Euro USD, you trade, call it Aussie USD, so AD USD, we'll do cable as well, and we'll throw into the mix Kiwi dollar. Right, so let's say you trade this set and you're also looking at the DXY. So the DXY, which is what I believe most people neglect, this is the point, you're neglecting this 1000%. I've spoken to enough people now, whether it's in the community, outside the community, on the street, right, talking to me about the DXY and why they don't use it, because the market is a fractal and they're so zoomed into lower time frames. It's where all the issues are. What I do find though is these same individuals that just trade one or two instruments, they actually take some really great trades, like really, really good trades. And then when I look at the journals, I'm like, you're actually doing a lot of the good stuff. It's the in-between of constant drawdown, big swings, relying on these periods. Like when it's good, but when it's bad, it's like really bad. They lose all their funding. So that to me, I look at that as a red flag. As well, when it's good, it's really good, but when it's bad, it's really, really bad. Well, can you deal with the really, really bad? Because the really, really bad is you losing all of your funding. That to me is not really sustainable. So that's why I have a problem with it. But I've got a fix for you. I almost guarantee you don't let your winners run. And you don't know the percentage. And this is the clue right here. The clue is the percentage. So let's say, for example, your average trade, you're profiting 2%, right? You're getting 2 to 1. If your average trade is a 2 to 1 and you look at your winning trades, and I want you to look through all of them, let's say you've got 10 winning trades over, I don't know, 40, 50 trades over 3 months, whatever the data sample size is. I want you to look at all of those wins, study those wins, and I want you to see how far do they run in comparison to what you get. If you're profitable, perfect. If you're scaling up, everything's good, then this video is not for you. There's no issue to you. But if you're consistently doing that loop and you're back in drawdown over and over again, there's probably a problem with this. You do not know how far your winners run. So if your average winner is running for, let's say, not even pie in the sky figures, let's say it's 5%. I'm not saying that you have to get the whole 5%, but if you're taking partials and that you're not letting those winners run and you're constantly in drawdown, there is an issue. So you need to fix that. So the first point of call is to just go through the sample of trades like I told you, and then you will figure it out. Now, there's another part to this, which is more from a technical point of view. I'll actually show you that on charts in a second. There is a technical point of view, is that your lack of value for this is actually messing you up. So it's all about commitment in the market. What did I say earlier? My goal as a trader, is what I've done for years, over a decade now, is to try to identify if I want to catch a wave, whether it's a trend, a range, you name it, I just want to look at what does it look like on which time frame, whether it's a weekly, daily, monthly, that helps me position myself with a bigger amount of momentum and volume is going to come in that I can't affect. So as long as I can ride that wave, that's all good, because if I have a strategy based off of that, I'm always following where the money is. So I think we can all agree on that. It's a very, very good system to have. So then it's all the intricacies. That how does the DXY come into this? So what we're going to do now, we're going to move over to the charts. I'm going to show you some examples and see how the commitment side of things is really, really important. One last thing that I think that could help you out. Imagine this, you go on a date. Do you marry that person, no matter how good the date is on the first date? You wouldn't go on a date and go, oh, this is a really good date, it checked all of the boxes, everything was all good, and you would get married. Why? Because you need more micro commitments. It doesn't matter how good that one single date was, that doesn't require full commitment. It's the same thing with people's trades. They get tick, 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 all of the stars align, they over risk. And you've probably done that many, many times because you marry the one single trade. You marry the one single idea without thinking about what does it actually look like from a technical point of view to see those commitments where the market is actually giving you permission to get involved from a longer term. This actually leads into what I spoke about with letting your winners run. You have to see commitment first to be able to let those winners run. So there's a two sides to it. So let's get into the technicals anyway. I want to show you a few things. Right, so this was the set that I was talking about. So you've got Euro dollar, Aussie dollar, Kiwi dollar, pound dollar, but we have the DXY. So when I speak about commitment, this is what I mean. You got to know what it looks like. So this is where I will hedge this either way. We know for a fact, and if you don't know already, this is going to help you, what happens if the DXY, not in just one candle, but if the DXY moves to the top of this range to fill these gaps. Now you can see quite clearly you've got this gap between this major high at the top of the range. You have this gap between this area, which naturally price is going to seek that area. Now you've got your bearish engulfing down here into this low. You've got your major low here, which is still a potential for a target, which I'm going to explain this hedge play, how it can help you out. But then you also have the bigger picture. So we know it's possible to be moving both directions. That's kind of stating the obvious, but it's about what does it actually look like. Anyone can say buy or sell, but it's different in how you can actually predict it in the first place. For nearly 8 years, I've predicted almost every single run on the DXY. Go back all of my webinars, you can see it from the early stage. You can probably see it on YouTube. So it's about picking a direction and how do you help that with positioning. So if we look at this bigger picture here, what have you got? You've got this bearish engulfing and you have your bullish engulfing. If you measure this, is a quick little tip here. If you measure this, you can see 50%, over 50% of this bullish candle has closed higher than the bearish candle. That's your first clue. Now, because we had the possibility to head into this low, we needed continuation after on a lower time frame to confirm that. So when you trickle lower like this and then you close bullishly on the weekly above that, and then you close above or equal to the previous bearish engulfing, that's pretty much your commitment bang on there. So we've now fallen into the category of we are now more likely statistically to move higher than not. Where does the problem happen? The problem happens right here. I said statistically higher, which is much more likely to move higher. But then what happens is, let's say there's a 10% possibility we're going to go from here to here to still tap this low, which is still possible. You accepted that 10%, that's the problem. You didn't accept there's a 100% chance of that 10% happening. And that is the issue in people's minds. and that causes hesitation with trades, etc. So that's one little clue that you can look at here. So the market is telling you a story, and I was talking about this in the middle of the week as we was looking to close very bullish. I spoke about this closing above this area or equal to here. This is we're going to start to see the signs of the real commitment. Why am I telling you this? Why is this important? Well, you have to go to the daily to be able to actually factor something in. So if we look at the daily time frame right here, the daily is going to give us a little bit of a clue as to, is there a possibility that we could return from here, go a little bit lower, and then move into this low? I would, of course, confirm this with some lower time frames like the H4, like the 1 hour time frame. It would be very obvious as a hedge play. So then again, I'm not marrying this one idea of, well, because the DXY is bullish on the weekly, it has to go to the upside. No, that's not how we do things. It's about understanding, like what I said on the whiteboard, what does it actually look like when the bigger players are stepping in, and where are the traps? So this is where I'd see a trap. So if we look here on the daily time frame, this is where I can see potential retest of this area, but we've broken above. So I'm looking for continuation. I know there's a possibility the price can come into this low. So this helps us massively when we're looking at position. So imagine I go back to the same point. You're looking for your sample trades and you say, Mark, I actually don't let my winners run. Well, why is this important right now? Well, if this H4 is closing above these areas and we at least hold this base, price can still come into this region, and I still wouldn't be looking for the DXY to move into the downside. I'd be looking for this base to be invalidated because this is the base of the buy. So as long as we hold either up here or we come into this region and we stay and then move away, then we know once we break above out of this structure, that would confirm that weekly play. If the weekly play is confirmed and we start moving to the upside, well, imagine you're someone who looks through your trades and you realize you cut your trade short. Are you going to do that now if you're positioning yourself in a trade for a buy here, USD related, etc.? Are you going to do that? Definitely not. You're going to take something like a euro dollar sell and you're going to hold it. You're not going to get out for a 2-to-1 because why would you? You're in drawdown. You're consistently making the same mistake, not realizing that the positioning of the market after we had got people caught on the wrong side, you can see there's been full commitment on the higher time frame. Why would you want to cap the trade when you've got every sign showing you that we're going to move a lot higher? It's not about greed. It's about outperforming your drawdown and making sure that when the market is good, you take full advantage of it, because you know what it's like. The market can be really slow, tedious, boring. It can be choppy. It can be messy. So you best believe when the market is flowing, you want to take full advantage of those opportunities. So what does this mean for us? Well, euro dollar, it would be the equivalent. This would be criminal. I would know exactly what to look for, just very quickly on the DXY. If we sold back in below that area that I just showed you, that is where I would look for price, because at this point, it's not committed here. I would be looking for price to come into here. Forget about the entry criteria, what I'd look for, all the other variables. I'm talking about from a structural point of view. I'd be looking at this point. If we saw this, there is like a 90% chance we're going to take out that low and move towards 99.5, right? And you'll see that. If we hold, we're moving all the way back up into a full-on bull run. My instincts tell me, based off of structure, we are going to move into this area here to fill this gap, moving towards these highs. That makes more sense, and we can return back later. So that's the DXY element. Well, why is that important now? Well, if you're selling euro dollar, it would be the equivalent of knowing that selling euro dollar from here to, let's say, here and getting out at a 2-to-1 or a 3-to-1. That would be absolutely criminal, and is a reason why you're still in the same position. That's why you keep losing, because you take really good trades in the right areas, but you leave money on the table, and you consistently leave a lot on the table. So I would do that for euro dollar. Why does that leave me to Aussie dollar? Well, same thing. If I look at the weekly and I look at what I showed you as an A to B range, this is a prime example. Look at that. There's your high, there's your gap. Who do you think's doing that? Who do you think is creating that weekly candle? You can see equal to or further. This is beautiful. This is the exact sort of formation in the right area that you need. So when I'm looking at a profile like this on the weekly, I'm expecting to play that range. If the DXY is going to do what we think it's going to do, this is the A to B movement that you need. So again, it's the equivalent of this is why I love the way that we trade. It's so simple, so effective. Structure is structure. You can't argue with it, right? Even the move up here into that V, right? There's no coincidence why we moved into that. Let me actually just measure this. Just want to see here. You can't make it up. You cannot make it up. Bang on 90%. Like, Anyway, I don't want to digress too much here. That's for mechanics. But essentially, playing this A to B range here, this is where if I'm in a trade, I want to hold this for as long as possible because I don't want to cap my trade from understanding positioning, seeing the DXY move to the upside. We know that by default, Aussie dollar's coming down. We know by default, Kiwi dollar is coming to the downside. You can see the base that it's holding right now. But the bigger picture is that we are playing this range. Even if I remove all of this, we keep it really simple. If you're playing this A to B leg, we're 50% of the way through. You can see on the weekly time frame that we've got some form of a base. So we're either holding here, right, and this gives us a nice hedge. I'll tell you why. Because let's say, for example, the DXY was going to come lower again to take out that low that I spoke about. Guess what? That gives me a nice hedge play because I know by default if the DXY is going higher, Kiwi dollar is selling off to that low. Well, that means for me, I can take a message from the market and look for a counter long into the highs if that's the case. So that's how dynamic it is when you understand positioning. But if you're too zoomed into a lower time frame and you're analyzing on executional time frames, is what I call them. That's my belief anyway. I believe these to be executional time frames and not time frames that you actually analyze on. Well, then you're going to be taking a whole bunch of losses that you could avoid. There's a difference between trades that just lose, because that's part of it. There are losses, but there are avoidable losses by understanding the DXY on a much deeper level. And that's why we go into so much detail within our community. I'm going into all the different variables and scenarios to prepare people for that, because that's your edge. Your edge is understanding where the bigger players are. Your edge is in your mental framework. Your edge is not just in the strategy statistics. It's how are you any different? How do you gain an advantage over the average trader if all you know is the same thing that everybody else knows online, talking about the same thing? There's a million other videos of people talking about all these different variations of all these complicated concepts that are just actually simple things, just rebranded, renamed. The market is the market. It's been doing the same thing for over 35, 40 years, if not more. So if I take something like a pound dollar in this scenario, what am I going to tell you? What you tell me, what do you think is going to happen to pound dollar if the DXY moves from point A to point B, even to this next swing right there? If we move from here to here, what happens to pound dollar? That's the most simple thing that you could look at. So then again, it changes your perspective because you're looking at that thinking, well, if that commits, and we're showing signs of actual commitment where there's enough people, there's enough sellers caught off guard that the DXY is looking very bullish, USD is looking very bullish, that it makes sense for this to come in to this low, which means that you can start to look for more generous targets like target 1, target 2, target 3 without thinking something like a sell on pound dollar that this is your target. No, this is your first level to see whether the buy is still potentially in play, and this is more an expanded play that you see an aggressive price move into that high. That would be that. This is not your target for a sell. This is another example of you taking a really good trade in a good area, but you cut it short here. You're leaving so much money on the table. You should at least be targeting down here. But again, if you're constantly anxious and you just want to be in and out the market as quick as possible, I get it. But I'm not talking to the profitable traders. If you're extremely profitable at 1-to-1, 2-to-1, and you're not going through those big strings to draw down, then keep doing your thing. But from my experience, over 95% of the people that trade that way that I end up speaking to, they have the exact same issues. They get really great trades, but they also, when it's bad, it's really bloody bad. And it's almost unenjoyable to the point that how many more losses do you need to take to realize this is actually not a good way for me to trade? That's my perspective anyway. At the end of the day, you're in this to make money, but you also want it to be sustainable. You can't get rid of all of the stress because trading has an element of stress, and the better that you deal with the stress, that's why I talk about emotional regulation has to come into play. That's your edge. How are you here thinking that your edge is just in your system? There's loads of people that know the same system as you. Where do you think about edge? What is edge? It's for you to gain an advantage. How do you gain an advantage over the average trader that has the same tools as you? Well, it's going to be your mental framework as well, isn't it? It's going to be all fused together. That's why you need everything. You need a system, you need a high quality plan, and you need the mental regulation to be able to execute on the edge that you have in the first place. Edge is well-rounded. That's why we become the well-rounded trader. So I really, really hope that helps give you a perspective of how much of the lack of value to something like this simple as the DXY's positioning is holding you back? And are you marrying just one side of the trade without even realizing it? This is super important stuff. You make money when retail doesn't, but what does that actually look like?